The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk, and it is possible to lose principal and interest when investing in securities. No strategy can guarantee a profit or prevent against a loss. The views expressed represent the personal opinions of the presenter or the featured guests, not necessarily those of USA Financial or its affiliated subsidiaries. Any opinions or forecasting statements are subject to change at any time and without notice. John Cyndia is an investment advisor representative of, and advisory services are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. Life Stages Advisory, Dean, and Remington are not affiliated with USA Financial Securities. Welcome to episode 54 of WTF, Wealth, Taxes, and Finances. I'm your host, John Cyndia, certified public accountant, personal financial specialist. I have Dean and Remington in the studio again today, as usual. Hello, guys.
Hello. How do you do, John?
How do I do what, Dean?
How do you do?
How do I do?
Just how do you do?
Well, let's see.
How do you do it?
Okay.
Are you going to teach us about finances today?
You know what, boys and girls, what I'm going to do today.
Gather around.
We're gonna talk a little bit more, expand a little bit more on taxes, because a little bit every week comes out more and more about some Biden tax proposals. And not that they're good or bad, it's just I want to have you be aware of what's going to happen, possibly, if they make the changes this year, which is another thing that until the House and Senate get together and start voting on some of these things, it could be later in the year. And for several years, things weren't done until December, and you only had a couple of weeks to try and decide what was going on, which wasn't really fair to the taxpayers or business owners or whatever. But that's just the way Congress works, I guess. So what we're going to look at today is a few other things, and then we're going to go through, Dean had actually started this wanting to know exactly how capital gains are taxed and how they work and everything. So we'll give you a standard basis on that first, see how they're working today, and then how they may be impacted for you or anyone else going forward with the new administration. So let's start, first of all, what is a capital gain? Capital gain is an asset that is held for normally investment purposes. A lot of people think of stocks or something first. So if you bought a stock for $1,000, it goes up to $10,000, and you sell it, you'd have a $9,000 gain. Now, depending on the length of time you held that is how it's going to get taxed under current tax laws. So if you hold it for less than 12 months or a year, it's going to be taxed at ordinary income rates, and ordinary income would be based on all of your potential taxable income. That would be wages, interest, dividends. If you're older and you had Social Security, anything like that would be in there. And then based on that, there's a separate side calculation to see whether or not you have long-term or short-term gain on any asset you may have sold. So it could be 0, it could be 10, it could be 12%. It could be as high as currently 37%. The new administration is looking to take that 37 top tax rate back to 39.6, and then you would end up having your gain taxed at 39.6%. So whatever that is times 9, you're looking at say $3,600 or something. And if it's long term, it could be 0, it could be 10, 15, or as much as 20%. And if you're over 400,000, it's usually 20% plus 3.8% for the additional tax from the Medicare. So while you get into it, it could be several different rates, but the determination of whether it's a capital gain tax rate or an ordinary rate is the 1-year hold period. So if it's held for less than that, it's usually ordinary rates. If it's held for longer than that, then you're going to fall in under one of the capital gains rates. Okay. There again, it's going to be dictated by how much money you currently make and what your adjusted gross income would be. And then, Dean, you had asked like when you would pay that tax. Normally, that tax you could estimate what it could be. Say if you sold something in June, you could make an estimated tax payment, okay, for that, or
Okay.
you could wait until the end of the year and pay the difference in the taxes, depending on a number of things. If you're in like a safe harbor amount, you won't have any penalties or anything. And then as long as you usually pay that tax liability by April 15th, you're pretty good to go. Okay.
Okay. So, oh gosh, I forget what I was thinking about. I'm trying to think of how to word it.
Can you exchange? Some people thinking that they can exchange things.
Yeah, like could I turn, like if I was in if I made a risky bet on a certain stock,
Okay.
I'm gonna call it that. Could I then again pull that money and put it into something more surefire that I know is not really gonna, fall or drop, do anything like that? Could I do that? Hold it in that stock for a year and then pull and then only pay long term?
Well, without getting into the weeds, no. It used to be different things that you could do to possibly defer those taxes, either from a reinvestment standpoint. Business could do it. They had some piece of equipment. If they traded the equipment, they wouldn't have to recognize the gain first. But the laws have changed over the last few years, and now even if you try to trade something, you have to recognize the gain, then turn around and get the new vehicle or whatever equipment you purchased, and then take that as a deduction. So we used to be able to trade basis and do different things that way. But
can't really do that anymore.
No, you can't.
So basically, if I wanted to win long term, I would have to keep my money in there.
You'd have
in
to
that
do it.
Single investment for at least a year.
At least a year.
Okay, so no matter what, pretty much if you're trading, you're short term.
Short term, exactly. Yeah. Day traders, it's all short term income. And if they're doing that for a business, now that could turn around and become self-employment and be subject to Social Security taxes too. But you have to be deemed a trader and everything else. So day traders are one thing, and then professional trades and doing that as a living as opposed to a hobby. There's a fine line in there, and you have to get into a lot of different attributes to verify exactly, what standard are you going to hit. Is that going to be a hobby that you're going to have at a short-term gains in ordinary income, or is it going to be deemed self-employment at this point? And, you'd have to go through a pretty much a checklist to try and, determine that stuff. But, yeah, day traders are going to pretty much always be just deemed short-term income. And if it's that risky and you've got a possibility of cashing out with a 300% gain or hanging on and losing 100%, cash it out, pay your taxes.
You still win.
You'd still be ahead because if you're up 300% and you have to pay a third of that in taxes, you're still up 200%, right, from where you were. So you're still up. So, it's too many times people get caught up into tax situations, and it just doesn't make sense. At one point in time, back in the, would have been 60s, 70s, top tax rates were up into 70%. Okay.
Oh my gosh.
So that's what sort of fostered the fact of all of these leveraging techniques that oil and gas companies had with intangible drilling rights. At the time, real estate was only 15-year depreciation, not 39 years, and on commercial properties and stuff. And you could really accelerate some things. And what happened, especially like with the oil and gas, if you put $100,000 down, you could put, say, I want a $100,000 piece of this. I'm only going to put $10,000 down. I could write off the whole $100,000. Okay, and so a lot of these people were deferring things, getting big tax write-offs and everything, and that phased out from about 80, let me see now, about 81 through 86. I think it was 4 or 5 year phase out. But what ended up happening at that point, that made sense, because if, say, you had a $10,000 deduction, Uncle Sam paid 70% of it.
Right.
Okay, so you had 30% that you were responsible for. When it became 50-50, it's a toss-up. Reagan came in and had the top tax rate of 28%. Now you have to, I still had people saying, well, I've got to keep a mortgage on because I'm getting a 28% deduction on all that interest I'm paying. And you were paying 17 and 18% interest back then. And, well, I need that big deduction. Your deduction's 28%. That means if I've got $10,000 in interest, I'm getting a $2,800 tax benefit. But I spent $10,000 on interest. That meant $7,200 went out of my pocket, and I got no benefit for it. Now, if you're in a 50% bracket, I got $5,000 versus spending $5,000 on my interest. When it's 70%, yeah, let's go buy that house because Uncle Sam's giving me a $7,000 benefit, when I only pay $3,000 on that. So a lot of people get stuck in the weeds with this stuff about, this tax situation. But then it comes down to cash flow. Okay? If you're spending at 28% rate, say, and you've got $10,000 of interest, but you didn't need to pay that or pay it in cash or do whatever, why are you paying $7,200? It's still going out of your pocket, So you really have to go through the numbers. I said before, use, OPM, other people's money. And with the rates being so low now.
Can I use your money?
No, you can't.
Dang it.
I don't have other people using my money. I'm using theirs. I keep my money. But when you start looking at it, it's a cash flow situation. There's certain things that restrictions on those deductions, on the state and local taxes, the SALT, if you ever heard of that, state and local tax, the real estate tax, state in Ohio taxes, and then city taxes that we have. They're limited to $10,000. Okay, Trump put that in. Well, that's been hurting a lot of people in New York, New Jersey, California, Massachusetts, a lot of the higher taxing states, because it's nothing for them to have $25,000 to $35,000, $40,000 of real estate tax in some of these areas. Now they're limited to $10,000. Okay, there were some other limitations that went along with that based on income. But if you're in a 30% bracket and you just did away with $30-some thousand worth of deductions, you got $9,000-$10,000 more tax that you're going to incur that you never had before.
Right. Yeah.
So you load that up, and having these other states increase whether it's their sales tax, it's their state taxes, and you look at the deductions that you don't have versus what you did have. And now looking at some other rates increasing or deductions being taken away, we have to try and consider, what's best for everybody for the long term. So on these on the capital gain side, what one of the proposals is now that anything over $1 million of capital gains would end up being at ordinary income. Now, are they going to maintain under $1 million for that? They've also talked about, from an inheritance standpoint, it could affect estates that normally you get a step up in basis. So if I had bought a stock for $10,000 and it's, or one of my relatives that passed away bought it for $10,000 and it's worth $100, and I inherit that, now we get a step up to $100,000, and because of the way the estate exemptions are, no taxes would be paid on that. What they're looking at now is to say, at the time of death, there's going to be a $90,000 capital gain on that. So they're not having a step up in basis from 10 to 100. They're going to recognize that at that point in time.
It's normal what it was actually originally paid for.
Right. So there's not, the basis would be transferred. There would not be a step up.
That's no fun.
Well, and then they're not going to maintain that $11.5 million of exemption. It could go down to $5 million or the $3.5 million that it was when Obama was in office. And prior to that, it was $1 million. And several years before that, it was down to like 600,000, and then it started getting indexed with inflation. But that's going to put a lot more people into play, especially since the stock market over the last 8-10 years has grown so much, and individuals are going to now have to look at redoing or updating their estate plans, because now, when they were protected by the exemption on the federal side, or as in Ohio, we have no state or estate tax again. Now all of a sudden it's going to put a lot of people back into play. So that's going to have a lot of effect on estates, cash flow situations, people that have a lot of real estate. It's going to have some major planning issues and opportunities, and it's going to put life insurance back into the play again. And I'm going to have a future episode that's going to be more on the attributes of cash value life insurance that could supplant and be utilized for estate planning, could be the death benefit you need for cash flow, could be a supplemental income play, and it could also be a situation that I like to call it super Roth, because if some of these 401k plan changes come into existence with the new administration, it's going to be about a 4 or 5 prong approach that cash value life insurance could end up helping down the road with all of these new tax changes. So I don't know if hopefully I answered a lot of your questions on the capital gains.
Yeah, sure.
The other thing I want to hit on briefly too is the 401k. The new administration is looking at plans for that you would no longer get a current or an immediate deduction based on your deferral amounts. So say you have $1,000 or deferred in a month, okay, that you've got taken out of your pay. Right now, if your monthly pay was $5,000, you have 401k deferral that you put in, you get taxed federally and state at $4,000. Okay, what they're looking at now is that deduction would not be there, so you would have basically the earnings would still be $5,000, but they would have it based on a 26% tax credit. Okay, so if someone's earning, say, $70,000, what they're trying to do is equalize the benefit, because if someone is in a 12% bracket and they deferred $1,000, they're really only getting a $120 tax benefit. Okay, if someone is earning $300,000 or $400,000 and they're at a 35% bracket, they're going to get a $350 tax benefit because they're in a 35% tax bracket. It doesn't sound like a lot, but if you're into, you've got $10,000, that person at the lower level is only $1,200 benefit for the year. Okay, the individual at the higher wage level is getting a $3,500. It's almost 3 times as much. Okay, so what they're looking at now is making it equal. So it's going to be a flat 26% tax credit. Okay, so the person on the 12% bracket is almost getting a doubling effect, $2,600 versus $1,200.
And the person at the higher
is getting screwed or getting less, at about a third less. The other thing is that, so some of the reports were saying, well, he's going to be taxing 401k deferrals. Well, it's not a tax, it's the tax credit. So some people are going to get a benefit, others are not. The other thing is at the lower level, that's going to be a refundable credit. So if the person was down at a 12% bracket, had only $1,000, okay, say they had $1,000 of tax, but they were able to turn around and have, they get their 26% credit, okay, off of that. They put 10 grand in. They only had $1,000 liability. Well, that $2,600 that they would have off of that would be refundable. 1,000 would offset the tax. The other 1,600 gets sent back to them in a refund, which is different, way different than what we got now. Now, if they turned around and had 10,000 of taxes minus the $2,600, then they'd have $7,400 that they'd have to pay in taxes. But it's going to be a full refundable credit. So a lot different than how it's been handled. Now, I was looking also to try and see, the wording is stating that people in a higher tax bracket may want to then, if they have it affordable or available to them, move over to a 401k with the Roth provision. So that's telling me that all this is doing is, instead of you getting a current deduction and seeing it in your pay stub, you're going to get this credit, and it would end up being either a little more or a little less based on what that is. You're not having the wages changed. Okay, so you're going to be taxed at $50,000 rather than $40,000, okay, on that from a federal standpoint, but you have the tax credit. And then you turn around, and when you do retire and you have the distributions, there's still going to be a tax on that. So I didn't see where, anything was changing from the taxation of what's in there. So it's not going to revert to a Roth. So that's why they were talking about you may go to a Roth. It's still going to be a deferral, and when you take that out, it looks like it's still going to be taxable. So it's still not real clear.
Like a double tax kind of in a way?
You're getting a tax credit up front instead of the reduction, coming out as a deduction on your reduced payroll.
Yeah.
So currently, you end up pulling that out. You get taxed at whatever rate you're at that time. It appears that when you pull that out, it's still going to be taxable.
Right.
Okay. It's just a fact that the way we're looking at it currently, it's deferred, and now it's a situation that it's still really deferred, but they're just going to tax it and give you a benefit currently through a tax credit rather than a tax deduction. So gets a little hairy there, but I'll keep everybody posted and seeing exactly what's going to happen, down the road for all this stuff. There was something else that was in there that I saw. Oh, they were talking about, who's available and who does and doesn't have. I've still got my paper.
Yeah,
Okay.
I'm over here cringing, as is anyone else listening.
Okay. If you've been staying with us here throughout the episodes, I'm a paper guy. These geeks here are iPad, and I promised that I would look at getting iPads so that we could
He's making me
eliminate this.
paper.
So at some future episode, we'll have iPads.
You
okay?
can highlight on an iPad. I see that's what you like to do. We could show you how to use the iPad.
You know
also.
what I'm going to do? I'm going to make sure my iPad has a paper crinkling thing. You can hear.
We'll just have a little soundboard. Just
Yeah, we have a soundboard for your paper.
Yes, it'll be a whatever is there. But I guess it has in here statistically, easy for me to say, millennials are the least likely to have access to an employer-sponsored plan. That 41% have them. Over a third of Gen Xers and 30% of baby boomers are unable to take advantage of these plans. So it's quite a large amount. And what they're also looking at is if someone like that does not have a plan going, they are looking at putting in individual type, I guess almost a pseudo individual 401k that they could set aside on their own.
So you wouldn't need an employer.
Doesn't look like it. It looks like, you're going to have the capability of doing something, on your own, and which would be unique, would be interesting. And, like I say, I'll keep you posted as to seeing, what other benefits are going to be there, from that. And it also goes along in saying that care providers for individuals who stay home to take care of an elderly or disabled member of the family are going to have some type of a benefit that they can set aside, even though they're maybe not actually getting paid to do what they're doing. Now, how that's going to get formulated, I'm not sure yet either, but keep you posted. And what I also wanted to do was tell you that for future episodes, we're going to be doing some other things that, we do this primarily for your financial health because of taxes and investments and things like that. But also, you need to have physical health. And in the next few episodes going forward here, I'm going to have a couple of different people in. One's going to be, since everybody's been sort of sequestered and sheltered and quarantined over the last year, going on into the second year now with the COVID, and it's going to be several months before this comes out, we're looking at having a counselor here for mental health. So we're going to talk about a little bit of mental health capabilities of what you can do, because if you're not mentally or physically capable of maintaining things, then it could have an effect on you financially anyway, because we've had a lot of people that have had issues. They've lost jobs. It's worked on them mentally. They've lost, in the verge of losing homes. They've lost jobs. They're going through their savings if they had anything. So now it's become kind of a financial, mental, and physical crunch to them, and has impacted them in several different ways. So what we'd like to do is say, hey, if there is a way, we'll have a counselor on from a mental health aspect, may talk to you about how to cope in some isolation. Also going to have another medical professional that's one of the clients. Is going to be talking about how to keep your body in good physical condition. We're going to talk a little bit about some home remedies and some things that you can do on your own to supplement with exercise and everything. So that will work into the framework. And we also are looking to have, a couple future episodes, we're going to look across the pond. We've got someone that we may be talking to from London. And she's a delightful lady that we met here a month or so ago. And she has her own podcast. And we're going to tell you a little bit more about that and see if we can do some across the pond beneficial podcast together. We're going to do
comparisons of what's going on in the UK and the US.
Yeah, we're going to talk about how COVID's affecting them. It's very restrictive over there. What that has done to them financially, and she's got some very unique savings ideas and different things that we discussed before, of doing like a percentage or an hourly piece of whatever you're earning, like 1 hour out of an 8-hour day. She's got it from a little bit different perspective of saving certain amounts. Hers are in pounds instead of dollars. But we talked for a little while, and we've got a few different ideas. Remington ran across her and has been in touch with her and everything. And it sounds like we've got some things that, would benefit our listeners, and hopefully we can benefit some of her listeners over there across the pond. But I think it'll be fun. And, it still has a retirement savings and investment slant on it. But I think incorporating some of these other guests that we're going to have on is going to hopefully encourage you to listen a little bit more intently and see how we can help, because it's one thing to have money, but it's another thing to not have your health, not to be mentally aware of what's happening. And just things have been going through with the family lately, and elderly individuals, helping them. It's becoming aware, making me more aware of certain things that, even though you do it from a planning perspective, until you get into it, there's some nuances in there that you really don't, you're really not aware of until it actually affects you or has the capacity to impact your life. And then once it does, I think I'd like to share that with everybody in just different ideas and things to be aware of and be ready for, so it doesn't sort of sneak up and bite you at the last minute and everything. So again, we want to encourage you to listen. What else do we want them to do anymore? Jeez, we've got all kinds of stuff.
Subscribe, share this with as many people as you think need to hear this.
Everybody needs to hear
Oh,
this.
If you're
Right.
not watching on YouTube,
Oh, YouTube, yes.
if you're not watching on YouTube, you
Shame.
probably should be. Shame on you. We've got some nice channel art made.
Yes.
I
yeah.
want everyone to see.
It's looking really nice.
and some thumbnails.
Make sure
Check
you
them out.
turn the notification bell on. You're subscribed. You're liking all the videos because we're posting weekly content. So
Yeah, it's pretty much going on with when the podcasts come out within either that same day or within a couple of days. We've got
it's not the same video, but it's
a different one will be coming out.
yeah, but it's same day, right?
Yeah.
Tuesdays?
Yeah. Tuesdays
Pretty
at
much.
noon.
Okay, great.
Same as the podcast.
So we've got the podcast you can listen to in the car, and then you can tune to us in the videos and everything.
See
On,
John's big shiny head.
That's right. They're making fun of me because of my hat I wore in today. My head was cold. So anyway, looked like, well, I was going to say Jungle Larry, but nobody know who Jungle Larry was unless you're from Ohio 50 years ago. Anyway, thanks again, and we'll see you soon.